So, a brand new CEO taking the wheel literally right as the company throws its long-term financial map out the window. It's a bold way to start your first day.
Yeah, better to rip the Band-Aid off now, right?
Oh, absolutely. Welcome to Earnings Unscripted, everyone. It is April 9th, 2026, and today we are looking at Constellation Brands, ticker STZ, that is their fiscal Q4. And honestly, Mero, it is a complicated print. They posted $1.92 billion in net sales, which is down about 14% from last quarter.
Right. Seasonal drop, but still heavy.
Yeah, and the operating margin just plunged to, 23%, down from over 31%. But the stock spiked over 4% today. So I'm trying to figure out why the market is rewarding them for losing visibility.
Because the market hates bad news, but it really hates uncertainty more. The numbers are out. The pain is known. So people just buy the baseline. Actually, before I dispense too much market philosophy, quick disclaimer, everything we say here is just our personal opinion, not financial advice, so please do your own research before making moves.
Yes, please do not base your retirement on us.
But going back to the tape, the stock action was pretty wild. It drifted down yesterday and stayed flat overnight, looked completely uninspired, but then it ripped higher right at the regular open today, closing up 4.2%. And I think it comes down to the fact that their comparable EPS hit $1.90, which, sure, it is a big drop from Q3, but it proved the core business isn't structurally broken.
Right. It proved they are still making money today, even if tomorrow is a total question mark, because they explicitly withdrew their fiscal 2028 targets. They just killed the long-term outlook. They blamed it on, I'm looking at the quote here, an evolving socioeconomic backdrop, which is a very polite corporate way to say the consumer is exhausted and we have absolutely no idea what they will buy next.
Right. They are flying blind, but I honestly respect the capitulation. Usually, management teams cling to these fictional 3-year plans until the wheels completely fall off. The outgoing CEO, Bill Newlands, is basically clearing the deck for Nick Fink to take over next week. It resets everything. Fink doesn't inherit a fantasy spreadsheet he has to constantly defend.
It is kind of the ultimate corporate housewarming gift. Lower the bar to the floor before he even moves his desk in. But seriously, even with all that macro caution, there is a really fascinating bright spot in the report. They called out Pacifico beer. It saw this massive 21% depletion growth. They're aggressively pushing those yellow cans at younger demographics, basically recycling the exact same playbook they used to build Modelo.
And they absolutely have to recycle it because Modelo, which has basically carried this stock on its back for 5 years, actually slipped this quarter. Total depletions ticked down roughly 1%. It's a tiny contraction, but when your main engine coughs, you need to make sure you have a backup thruster firing.
Down about 1%. Wow. Okay, if the crown jewel is actually stumbling, we really need to look under the hood here. All right, let's get into the details.
The first place to look is how they are suddenly guarding their cash. Because when your main engine loses momentum, the immediate reflex is to clamp down on capital spending. And we are seeing a massive strategic shift there.
Right, which is interesting because Constellation usually just builds nonstop. They're always expanding those huge Mexican breweries.
Exactly. The Veracruz facility has been a massive sink for cash over the years. But CFO Garth Hankinson said something quite revealing on the call. He stated they are now operating, quote, modularly, meaning they actually spent significantly less on CapEx this past year than they initially planned.
Modularity is a very nice corporate spin for slamming on the brakes.
Pretty much. He admitted some capacities getting delayed or possibly avoided altogether. They're only building what is strictly required to survive right now.
Well, they kind of have to do that, right? Because the fixed cost pressure on the beer side is brutal. I saw their beer operating margin shrank almost 500 basis points this quarter.
Down to 33.2%, yes.
Right, so you are selling fewer cases, but your overhead is still there. Plus, they specifically flagged increased depreciation and aluminum tariffs, which, I mean, that is just raw pain on the import side.
It is a textbook margin squeeze. Your inputs cost more, you absorb overhead across slightly less volume, and profitability takes a direct hit. But here's the part that actually caught me off guard. While they're playing incredible defense with the factory build-outs, they are simultaneously launching a highly aggressive offensive on marketing.
Oh, yeah, the World Cup bet. They are front-loading so much cash for that.
Up to 9.5% of net sales, entirely squeezed into the first half of the fiscal year.
Oh, that is a really, really high-stakes game. Because think about it. You're throwing all your chips onto a soccer tournament, hoping that cautious consumer decides to celebrate.
And if they stay home and buy cheaper local options instead, you basically starve your momentum for the back half of the year.
Which feels terrifying, given the lack of visibility they already warned us about. They're practically begging that tournament to work. Though I guess it's not just Modelo they're trying to pump up. They mentioned seeing surprising traction with some of the Tier 2 brands.
Yeah, specifically the Victoria brand, which I found genuinely interesting. Bill Newlands pointed out that Victoria actually more than doubled its trajectory recently among the 21 to 25 demographic.
Oh, wow. Younger buyers are notoriously hard to grab right now. They usually actively avoid the big legacy beer brand.
They do. But management thinks these younger Hispanic consumers are specifically adopting Victoria because it offers, quote, heritage and authenticity. It is not perceived as just another macro domestic product.
I love that. You cannot manufacture authenticity. And it gives them this really nice organic long-term foothold while the market share is so fractured.
It is a smart pivot. But to bring it back to reality, they absolutely need these beer bets to land flawlessly because the wine and spirits division cannot cover a single misstep right now. That segment is practically a ghost ship.
Okay, ghost ship is a little dramatic, Miro.
Let me give you the numbers and you tell me. Net sales collapsed 58% year over year.
Right, but a lot of that is structural. They did those massive divestitures last June, stripping out the mainstream wine brands.
Yes, the revenue drop is partly engineered, but the margin profile is completely broken. Guess what their operating margin for wine and spirits was this quarter?
If they dumped the low-end stuff, I would assume it is improving. Maybe 12%?
1.3%.
I'm sorry, what?
Barely above 1%?
1.3, down from 21.7% a year ago.
That is not a business, Miro. That is a hobby.
Exactly. It is acting as an enormous anchor on their enterprise returns right now. Management still claims the long-term goal is a low 20% margin, but Hankinson flat out acknowledged the time frame is going to take a bit longer than expected.
A bit longer is doing a phenomenal amount of work in that sentence.
It's entropy with a positive spin. So you have wine and spirits treading water at near zero margins and an entirely front-loaded World Cup strategy that absolutely must deliver.
Okay, so putting all those pieces on the board, where does this leave them as they step into this new, totally unguided fiscal year?
Well, it leaves them basically betting everything on execution over the next 6 months because their actual guidance for fiscal 2027 is, it is incredibly guarded. They are projecting enterprise organic net sales growth somewhere between -1% and +1%.
-1 to +1. That is, well, it is essentially flat. For a stock that has been valued as this reliable growth engine for years, that is a huge psychological reset for the market. And obviously for the new CEO.
Right. Nick Fink steps into a situation where the growth narrative is officially on pause. Although Garth Hankinson, the CFO, did try to defend the long-term view on the call. He said, let me check the exact wording right. He said they will return to growth and that the headwinds they are facing today are more cyclical in nature than they are structural.
Cyclical. Okay, yes. But I kind of struggle with that word here because maybe the beer consumer bouncing back is a cycle, but if we look at wine and spirits, they are only projecting a 5 to 6% margin for all of next year. That feels structural, or at least like a cycle that takes 5 years to fix.
That is a very fair point. Trudging through an inventory rebalancing at 5% margins does not exactly scream quick cyclical dip. So the real tell next quarter is whether that massive World Cup marketing bet actually forces a rebound in beer. If it does not, they have no margin cushion left.
Exactly. If consumers do not open their wallets for the matches, the back half of the year is going to be exceptionally painful. But hey, if Pacifico keeps exploding, maybe they pull it off.
We will find out if a yellow can is enough to carry an entire enterprise through a stalled economy.
I think that is the perfect note to end on, guys. Thanks for hanging out with us for this one.
See you after the next Brent.
And hey, if you want these breakdowns to just automatically show up for you, go ahead and give the show a follow. It really helps out our little project, especially since we use AI tools to quickly sift through hundreds of pages of SEC filings to pull these stories together. We also genuinely love hearing what tickers you want us to look at next. So drop us an email at earningsunscripted@datamadness.ca or just hit the X link in the show notes.
Catch you next time.